The power of compounding is often explained with formulas, charts, and impressive curves that rise sharply toward the end, but those visuals rarely capture what compounding truly represents in real life. Compounding is not a trick of finance. It is a discipline of time. It rewards those who act early consistently and patiently, and it punishes those who delay while waiting for certainty, confidence, or the right moment. When people say start investing early, they often hear advice meant for someone else, someone younger, someone with fewer responsibilities. In reality, the message is less about age and more about understanding how time behaves when money is allowed to stay invested. At its simplest, compounding means that returns begin to generate returns of their own. Your money works, then the work it does begins working as well. But this simple explanation hides an uncomfortable truth. Compounding feels weakest when it matters most. In the early years, progress is slow. Contributions dominate growth. The numbers look unimpressive. This is the phase where most people lose faith, conclude that investing doesn't really work, or decide to wait until they have more money. The tragedy is that this early phase, which feels insignificant, is the foundation on which everything else depends. What makes compounding powerful is not high returns. It is uninterrupted time. A moderate return over a long period almost always beats a high return over a short one. This is why starting early matters so much. Time does not add value linearly. It adds value exponentially. The difference between starting at 25 and starting at 35 is not 10 years of missed savings. It is 10 years of missed growth on growth. That loss cannot be recovered later by trying harder without taking significantly more risk, and that increased risk often introduces mistakes that compound in the wrong direction. One of the most misunderstood aspects of compounding is that it does not reward effort evenly. The final years often produce the largest absolute gains, even though the behavior required is the same as in the early years. This creates a psychological trap. People see others making large gains later in life and assume skill or luck is the primary factor. In reality, those gains are often the visible result of decades of quiet, boring consistency. Compounding hides its generosity until the end, which is why it feels so unfair to those who start late and so magical to those who start early. Starting early is not about having a lot of money. It is about establishing the habit of participation. Small amounts invested early matter more than large amounts invested late. This is deeply counterintuitive, especially in cultures that equate progress with visible scale. But compounding does not care about ego. It cares about time in the system. The investor who contributes modestly and consistently from an early age often outpaces the one who waits, saves aggressively later, and tries to make up for lost time. Another critical point is that compounding is fragile to interruption. It does not tolerate frequent stopping, restarting, or emotional exits. Selling during downturns, skipping contributions during uncertainty, or constantly changing strategies resets the compounding process repeatedly. Each reset costs more than it appears to in the moment. Compounding thrives on continuity. This is why automation simplicity and long-term alignment matter so much. The more decisions you remove from the process, the more likely compounding is allowed to do its work. Volatility, which scares many beginners away from investing, is not the enemy of compounding. Behavioral mistakes are. Market fluctuations are part of the environment compounding operates in. What matters is not avoiding volatility, but surviving it. Investors who remain invested through downturns allow compounding to benefit from recoveries. Those who exit often miss the very periods that accelerate long-term growth. Compounding does not require smooth returns. It requires presence. Taxes and fees also interact quietly with compounding. Small percentages lost each year to friction reduce the base on which future growth builds. Over decades, this erosion becomes enormous. This is why low-cost, tax-efficient investing is not a minor detail, but a compounding accelerator. Keeping more of what you earn allows time to work on a larger base. Compounding magnifies not just returns, but decisions about structure. Perhaps the most powerful benefit of starting early is psychological. Early investors learn to see investing as a long-term process rather than a performance contest. They experience downturns when the stakes are still manageable, building emotional resilience. They learn patience before large sums are involved. This early conditioning often determines whether an investor later trusts the process or sabotages it when pressure rises. Compounding rewards not just early capital, but early mindset. Many people delay investing because they believe they need more knowledge first. Education matters, but waiting for certainty is costly. Compounding favors participation over perfection. A simple, diversified approach started early and maintained consistently often outperforms sophisticated strategies adopted later. The goal is not to get everything right immediately, but to get started and improve gradually while time is still abundant. It is also important to recognize that compounding works in both directions. Poor habits compound as well. Delaying decisions, accumulating high-interest debt, or repeatedly exiting markets during stress create negative compounding that is just as powerful as positive compounding, only far more destructive. Starting early is not just about building wealth. It is about avoiding patterns that quietly undermine future options. The phrase "start investing early" is often delivered as advice. It should be understood as a warning. Time is the one input that cannot be increased later. You can save more later. You can learn more later. You can earn more later. You cannot add years back into the compounding equation. Every year spent waiting is a year compounding works against you rather than for you. As people move through life, the opportunity to benefit from compounding does not disappear, but its leverage changes. Early years offer maximum leverage with minimal capital. Later years require more capital and more discipline to achieve similar effects. Understanding this reality reframes investing from a race for returns into a race against inertia, hesitation, and delay. And once that perspective is clear, the next step is understanding how to actually set up an investing approach early in life that allows compounding to work without demanding constant attention, complex decisions, or unrealistic discipline, which is exactly where we need to go next, by examining how to actually harness the power of compounding in a simple, realistic way, rather than admiring it from a distance, because compounding only works for those who design their behavior to support it. The first practical step is choosing simplicity over optimization. Early investing should not be complex. Broad, diversified exposure to productive assets is enough. The greatest threat at the beginning is not choosing the wrong fund. It is not starting at all. A simple structure that you understand and can maintain through boredom and fear is vastly superior to a sophisticated plan you abandon after the first setback. Automation is the second pillar. Compounding thrives when it is fed regularly without requiring fresh decisions. Automatic contributions turn investing into infrastructure rather than intention. This removes the need for motivation timing or confidence. When money flows into investments by default, compounding continues quietly while attention is focused elsewhere. Investors who automate early rarely feel like heroes, but they often wake up years later surprised by how far consistency carried them. The third element is reinvestment without negotiation. Dividends, interest, and gains should be reinvested by default during accumulation years. Reinvestment is what allows compounding to stack on itself. The temptation to take small rewards early feels harmless, but it weakens the exponential curve when it is most sensitive. Consumption has its place later. Early on, restraint buys time, and time is the rarest input. Cost control matters more than excitement. Fees, taxes, and unnecessary turnover quietly drain the base on which compounding operates. Choosing low-cost vehicles and resisting frequent changes preserves fuel for growth. Over decades, this discipline can matter more than the difference between good and great returns. Compounding magnifies small advantages relentlessly, including the advantage of keeping more of what you earn. The fourth pillar is staying invested through discomfort. Early investors inevitably encounter volatility often before they fully trust the process. This is not a flaw, it is training. Remaining invested through downturns teaches a lesson that no book can recovery is real, but only for those who remain present. Compounding does not reward bravery in words, it rewards endurance in action. Another crucial habit is periodic but infrequent review. Compounding needs attention, but not obsession. Constant checking invites emotional interference. Scheduled reviews allow adjustments without panic. This rhythm protects the long-term process from short-term noise and keeps behavior aligned with intent. Perhaps the most important mindset shift is understanding that compounding is not a race against others, but a partnership with time. Comparing progress to peers invites impatience. Compounding unfolds privately. It does not announce itself early. Those who trust it often look foolish before they look wise. This is the price of exponential processes. They reward patience late and test it early. In the end, starting early is less about youth and more about humility. It is the decision to accept that small, ordinary actions repeated for a long time can outperform brilliance applied sporadically. Compounding is not impressed by confidence. It responds to consistency. Those who give it time, space, and continuity eventually discover that the most powerful force in investing is not prediction or timing, but the quiet accumulation of disciplined behavior. If this message resonates, consider subscribing to stay with these long-form conversations focused on building wealth through patience rather than pressure, and leave a comment sharing what has delayed your own investing journey in the past, because naming that delay is often the first step toward ensuring compounding finally starts working in your favor.